Imagine taking a century-old, really slow-moving government bureaucracy, and then just overnight, it starts growing at the speed of a Silicon Valley tech startup.
Yeah, which is, I mean, it's not something you see every day.
Exactly. Welcome to the Deep Dive. Today, we're taking on a journey through a pretty massive stack of sources. Specifically, we're looking at the Q1 2026 earnings report and the investor call transcript for YPF Sociedad Anónima.
Right, Argentina's state-backed energy giant.
Yeah. And our mission today is really to figure out how this legacy company is radically transforming itself, turning into this hyper-efficient, tech-driven powerhouse.
It's really a real-time case study in how to pull off a complete structural pivot. They're basically abandoning the whole traditional playbook of a sluggish national oil company.
Right.
And they're shifting entirely into high-tech shale extraction and liquefied natural gas. The numbers in this Q1 report, well, they suggest this isn't just like a minor operational tweak.
No, not at all.
It's a fundamental rewiring of a multi-billion-dollar corporation.
Okay, so let's unpack this rewiring, because the sheer scale of the financial windfall here is, it's wild.
Oh, absolutely.
They reported a record Q1 adjusted EBITDA, which, for those listening, is basically their pure operating profit before, all the accounting tricks and taxes are applied, of merely $1.6 billion.
Yeah, $1.6 billion.
But to understand where that cash is actually coming from, we have to start at ground level, right?
We do. We have to go straight to the Vaca Muerta shale formation. This is, without a doubt, the undisputed crown jewel of YPF's entire operation right now. And the data coming out of Vaca Muerta is just staggering.
Give us the numbers.
So in the first quarter, their shale oil production reached 205,000 barrels per day.
Wow.
Yeah, which represents a 39% increase year over year. And to put that into perspective for you, unconventional shale now makes up 76% of YPF's total oil output.
Wait, 76%? That is a massive shift away from their historical drilling. But, finding the oil is one thing, right? Getting it out of the ground at a profitable margin, that's entirely different.
And that brings us to this specific block within Vaca Muerta called Lanatura Sur, because 18 months ago, this specific block was producing a very modest, 2,000 barrels per day.
Okay, 2,000.
Right. Fast forward to this Q1 report, and Lanatura Sur is producing roughly 55,000 barrels per day.
Well, hold on.
Yeah.
55,000. So that's essentially 25 times more production in 18 months.
Exactly. A 25x jump.
See, that doesn't make intuitive sense to me for a physical commodity.
Right.
If I'm a software company, sure, I can scale a server 25 times overnight, right?
Right.
But you're talking about moving millions of gallons of physical liquid out of solid rock?
Yeah.
How is a jump that massive physically possible without, just breaking all the equipment?
Well, what's fascinating here is the underlying strategy that actually makes that leap possible. It really comes down to capital discipline and, geological focus. YPF is actively walking away from their mature conventional fields. In fact, those legacy fields saw a 45% production decline.
So they're just letting them fall off?
Yeah, because conventional drilling is, it's like looking for a buried pool of oil, right? It gets harder and way more expensive as the pool empties out.
Makes sense.
But unconventional shale, like Lanatura Sur, is entirely different. The oil is trapped inside the rock itself over massive, massive areas.
So it's not a pool.
Right. If you figure out the precise formula to crack that specific rock, you can just replicate it endlessly across the entire field. So YPF cracked the code for Lanatura Sur, and then they just poured all their capital into stamping out that exact same highly efficient well design over and over again.
Ah, I see. So they essentially turned oil extraction into a manufacturing assembly line.
Exactly.
And the economics of that assembly line are what really jump out from the sources you look at.
Oh, the margins are incredible.
Yeah. The break-even price for Lanatura Sur is below $40 per barrel. And the lifting cost, which, is the actual day-to-day cost to physically pump a barrel out of the ground once the well is already drilled,
right,
is just $3 per barrel.
$3.
And plus, YPF owns 100% of this block. They aren't splitting these margins with a partner.
Yeah, and when you have a lifting cost of $3 and international crude prices are hovering around, what, $80?
Yeah, something like that.
The cash generation is just immense. But, achieving a $3 lifting cost doesn't happen just by finding good rock.
Right. It can't just be luck.
No, it requires a totally different operational playbook. You have to essentially hack the mechanics of the oil field.
Which really begs the question, what exactly are they doing mechanically to pull this off? Because extracting oil at those margins requires next-generation operations. You can't just use traditional pump jacks.
Right, and they aren't. They are setting new mechanical records across the board by completely rethinking the fracking process itself.
Well,
For instance, at another major field called Loma Campana, they recently pumped continuously for almost 110 hours.
wait, continuously?
Yes, they completed 52 fracking stages in less than 5 days, which means they are averaging over 11 stages per set per day.
That's insane.
And on top of that, their drilling speed hit 364 meters per day, and they even had one well where they drilled 520 meters in a single 24-hour period.
My first thought when I hear about running heavy industrial equipment continuously for 110 hours or drilling 520 meters through solid earth in one day is, well, are they redlining the machinery?
It's a fair question.
Are they cutting corners on maintenance or safety just to get a short-term speed boost so they can show off on an earnings call?
It sounds like reckless speed, I know.
Right.
But the data points to genuine, sustainable precision.
Yeah, really. Yeah.
They are achieving this through really deep technological integration. YPF utilizes a centralized real-time intelligence center.
Like a mission control.
Exactly like a mission control. It monitors every single vibration and pressure metric across their operations, and they deploy drones to oversee the fields and, optimize all the logistics.
Wow.
Yeah, the CEO explicitly quoted their internal management philosophy on the call, stating, "Tomorrow we have to be more efficient than yesterday."
I mean, that sounds good, but what's the actual mechanical secret?
Right. The real mechanical secret to that 110-hour continuous pumping record is a recent 5-year agreement they signed with Halliburton.
Oh, the electric fracturing technology, e-fracking.
Precisely. They brought e-fracking to Vaca Muerta, which actually makes YPF the very first company outside of the United States to use this specific technology.
Okay, so what does e-fracking actually change on the ground? Why is it so superior to the traditional method?
Okay, so traditional fracking requires massive fleets of diesel engines just to power the pumps.
Right.
Think of dozens of massive semi-truck engines revving at maximum capacity simultaneously.
Sounds loud.
They are incredibly loud. And they require a constant logistical nightmare of fuel trucks driving back and forth. But worse, because they are combustible engines running right at the red line, they break down constantly.
Oh, I see.
Yeah, you have to start pumping just to do routine maintenance. E-fracking replaces all those diesel engines with electric motors powered directly by a turbine or even the grid.
And electric motors are just more reliable.
Much more. They provide steady, relentless torque. They don't vibrate themselves to pieces. They drastically lower emissions. And most importantly, they don't need coffee breaks.
Right.
That is the mechanism driving the speed. You can pump for 110 hours straight because electric motors simply don't need the downtime that diesel engines do.
That makes total sense. You just eliminate the mechanical bottlenecks entirely.
Exactly.
And I guess the proof that this is working sustainably is in their overall upstream lifting costs.
Mm-hmm.
It dropped 42% year over year, down to $8.80 per BOE, which, for you listening, BOE is a barrel of oil equivalent. It's the standard metric that combines both oil and gas production into one easy number.
Right. A really crucial metric.
And in their core shale hub, that cost is sitting at a best-in-class $4 per BOE. So they have clearly optimized the extraction.
Yeah.
But YPF isn't just an exploration company, right? They are fully integrated.
They are.
They drill the oil, sure, but they also run the refineries and they sell gasoline directly to the public.
Yeah, they control the entire value chain from the rock all the way to the gas pump.
So what happens when you have this incredibly cheap, highly profitable commodity flowing out of Vaca Muerta and it hits the local Argentine consumer?
Well, you get a really fascinating domestic balancing act. Because they are extracting so much crude so efficiently, YPF's refineries are running incredibly hot.
How hot?
They reported a 102% utilization rate, processing a record 344,000 barrels per day.
Wait, operating at 102%, that means they are literally pushing more volume through those pipes than the refineries were technically designed to handle on paper.
Yeah, they are maximizing every single inch of their infrastructure. And because of that massive internal efficiency, they achieved a major milestone this quarter.
Which was?
They completely eliminated the need for gasoline and diesel imports. They became entirely self-sufficient for the domestic market.
That's a huge deal for the country. But, The global market always has a say.
Always.
The sources note that in March, international oil prices spiked significantly due to geopolitical conflicts in the Middle East. And initially, YPF passed those higher international costs directly to local pump.
Right.
But local demand instantly dropped by 10%.
Yeah, when fuel prices surge that quickly, you see immediate demand destruction. Consumers consolidate trips, businesses slow down their transport, and people simply stop driving as much.
Right. And here's where it gets really interesting to me. In response to that 10% drop, YPF initiated a proactive, temporary 45-day price freeze in April.
Yeah, they did.
They essentially acted as a buffer for the consumer. But, okay, being a state majority-owned company, my immediate assumption is that the government stepped in, right? Like, they mandated this freeze to keep voters happy.
Right, that's the natural assumption.
But the management team explicitly stressed on the call that this was a purely commercial decision made by their own intelligence center with zero government interference.
And that distinction is just crucial. They aren't acting on a political mandate here. They are acting as an economic shock absorber because it is the most logical business move.
How so?
Well, if we connect this to the bigger picture, it really comes down to protecting the long-term health of their own revenue stream. In April, YPF's downstream EBITDA margin, which is the pure profit they make from refining and selling fuel, was incredibly robust.
What was it at?
It was sitting at roughly $24 per barrel.
So they had a massive cushion.
Exactly. They had more than enough margin to absorb a temporary shock. YPF is playing the long game here. I mean, destroying your own customer base's ability to buy fuel hurts the bottom line far more over a multi-year timeline than temporarily eating the cost of a one-month international price spike.
That makes a lot of sense.
Yeah, by freezing prices, they stabilized local demand, they kept the refineries running at that 102% capacity, and they maintained consumer loyalty. It's really just a calculated protection of their own demand curve.
Okay, so they've hacked the shale extraction, they're running refineries beyond capacity, and they've completely saturated the local market to the point of zero imports.
Right.
But to me, that creates a new problem, a bottleneck, right?
Right.
They are pulling gas out of the ground so fast and so cheaply that the domestic market physically cannot absorb it all.
Yeah, you hit a ceiling.
So what do you do when you have an ocean of trapped, really cheap energy?
Well, you have to freeze it, put it on a specialized boat, and sell it to the rest of the world. You build a liquefied natural gas, or LNG, terminal. And this brings us to the Argentina LNG project, which, honestly, YPF's management is calling the most transformational initiative in the company's entire history.
And the scale of this project in the sources is just eye-watering. The founding partners include YPF, the Italian energy giant Eni, and XRG, which is an international investment arm of ADNOC from the UAE.
Some heavy hitters.
Definitely. And the budget for just the midstream and downstream portions of this project is a staggering $24 billion.
$24 billion.
Yeah, and they're targeting a final investment decision by the end of 2026. So what does this all mean for the financial reality of the company? I mean, how does YPF, a company that reported about $5 billion in quarterly revenue, even begin to swallow a $24 billion mega project?
Yeah, it's a huge undertaking. It requires a fundamental restructuring of how they present themselves to international banks.
Yeah.
On the earnings call, management revealed a deliberate strategic shift to make this $24 billion project financeable. They basically moved their capital allocation away from the upstream, the actual drilling part, and heavily into the midstream and downstream.
Into the physical infrastructure,
Yeah.
right? Like the gas separation plant in New Queen and the massive pipelines running to the ocean part.
Yeah, exactly.
But why does moving money out of the oil fields and into the pipelines make international banks more willing to lend them billions?
Because banks absolutely hate the geological risk of drilling. I
Right.
mean, you can't easily get a global financial institution to lend you billions of dollars based on the, potential of gas buried 2 miles underground.
Right, it's too uncertain.
Exactly. But if you build a massive physical separation plant and a dedicated pipeline, well, suddenly you have hard assets. You have infrastructure that acts like a toll road.
Oh, I see.
The banks can look at that pipeline and know exactly how much revenue it will generate every single time gas flows through it, regardless of the daily fluctuations in drilling success. So by funding the midstream themselves, YPF is creating the hard collateral needed to secure the rest of the $24 billion from global markets.
That's brilliant. And the geopolitical timing seems to be playing right into their hands, too.
No, the timing is impeccable. That same Middle East volatility that caused the price spike at the Argentine pump back in March,
Yeah.
it's actually accelerating international investor appetite for secure energy sources.
Yeah.
Global markets are desperate for massive energy reserves located far away from geopolitical conflict zones.
Makes total sense.
Right. And Argentina, sitting on Vaca Muerta, is suddenly looking incredibly attractive. During a recent market sounding exercise, roughly 50 institutional investors showed an appetite that actually exceeded the project's financial requirements.
Wait, really? That is wild. They literally have more international capital wanting to fund this project than they actually need to build it.
Yeah, they're oversubscribed.
But executing a $24 billion terminal while simultaneously running this relentless shale drilling campaign, I mean, that requires immense internal discipline. Which brings us to the company's 4x4 plan and how they are basically cleaning up their own house to afford all of this.
Right, because you can't ask international banks for billions if your own balance sheet is a mess.
Exactly.
And Q1 showed a massive financial cleanup. They generated $871 million in free cash flow, which is an improvement of $1.8 billion compared to exactly a year ago.
Wow.
Their net leverage dropped down to 1.57 times, proving they are aggressively managing their debt. They even proactively prepaid $750 million in debt obligations.
Nice.
And when they did go to the international market to raise money, they secured an 8.1% yield bond, marking their best international borrowing rate in 9 years.
You know, it sounds like this 4x4 plan they keep mentioning is basically a massive garage sale of their legacy assets.
A garage sale? I like that.
Yeah, it's like realizing you're trying to win a Formula One race while towing a rusted-out camper van behind you.
Right.
The old conventional wells are the camper van. They're finally just cutting the hitch, selling the van for whatever cash they can get, and pouring that money straight into the F1 engine, which is the Vaca Muerta shale fields.
That is the precise mechanical reality of what they are doing. The core philosophy of the 4x4 plan is the ruthless divestment of the old to aggressively fund the new.
Right.
In just this quarter alone, they collected $410 million from selling their 50% stake in a fertilizer company called Profertil.
$410 million.
Yeah, and they collected another $85 million from selling off the Manatilas Bear conventional field. Every single dollar squeezed from the past is being injected directly into the shale and LNG future.
And honestly, you can feel the confidence of that strategy bleeding into the company culture, even just reading the dry transcript of a quarterly earnings call.
Oh, the culture shift is palpable.
Yeah. There is a moment where the CEO, Horacio Moran, literally tells the Wall Street analysts they have to be polite with their questions because it happens to be his 63rd birthday.
I remember that.
And not just his birthday, it was the CFO's birthday, too. The mood was incredibly light, but then he ended the call with this deeply intense declaration.
Yeah, he shifted from joking with analysts to stating point blank, I breathe YPF, I sweat YPF, I think YPF, I love YPF.
I mean, you just don't usually hear the leader of a multi-billion-dollar state energy firm speaking with that level of raw emotion to financial analysts. It's not just a spreadsheet optimization exercise for them. It feels like a genuine mission.
And, corporate culture directly dictates capital allocation. When the leadership is that intensely aligned behind a single aggressive vision shedding the conventional past to hyperfund the unconventional future, it trickles down to every operational decision.
That makes sense.
It's the reason the guys out in the field are pushing e-fracking equipment for 110 hours straight. And it's the reason the Intelligence Center has the autonomy to freeze domestic prices without waiting for a politician's permission.
So let's step back and look at the whole board here. YPF has essentially hacked the physical mechanics of shale extraction, utilizing electric fracking to drive lifting costs down to $3 a barrel. They've maximized their refineries to 102% capacity, completely eliminating domestic imports, and proactively stabilizing their own consumer market.
Right.
And now they are leveraging that hyper-efficiency to build the financial architecture for a $24 billion global LNG terminal.
Right.
All while radically liquidating their legacy assets to clean up their balance sheet.
It is a profound structural turnaround. But, we've spent this entire time talking about YPF transforming itself today.
Right.
The real thought to mull over for the future is geopolitical.
How so?
Well, if YPF actually pulls off this $24 billion LNG terminal by the end of the decade, Argentina doesn't just fix its own domestic economy.
Wait,
It suddenly has the infrastructure to replace regions like the Middle East and Russia as a primary, conflict-free energy supplier for Europe and Asia. This isn't just about a legacy company learning how to be profitable. It's about a single corporate pivot potentially shifting the global balance of energy power for the next 50 years.
It really makes you wonder how many other nations are watching this exact earnings report, looking at that Silicon Valley-style growth curve and realizing the entire map is about to be redrawn. I mean, could this 4x4 playbook become the new survival blueprint for national oil companies all around the world?
It's very possible.
Well, thank you so much for joining us on this deep dive. Keep questioning the numbers behind the headlines, and we'll see you next time.